It's shortly going to be 2022, and for me, it's a time where I review my portfolio and look at where it could potentially be improved. Part of that may be shifting positions out of the portfolio, but I don't like to do that unless something is seriously off with the investment thesis or valuations have reached bubble territory. The main thing for me is looking to add or building my watch list of stocks that I feel could not just do well in 2022, but far beyond that, way into the future. And these could be stocks that I either want to own and don't own already, or stocks I already own and want to buy more at a certain price. So in this video, I'm going to briefly take you through two stocks that I feel should be on your watch list in 2022 if they aren't already. Now, the first stock is one I've spoke about on this channel briefly, and a stock that is quite popular among the value investing community. That stock is Prosus. Ticker symbol is PRX. And it trades on the Amsterdam Stock Exchange. I think it is available on the US exchanges under PROSY, P-R-O-S-Y, but as I'm in Europe, AMS works best for me. Now, if you don't know much about Prosus, here is a bit of background on the business itself. Prosus is an investment holdings company that holds the international assets of South African conglomerate Naspers. They mainly hold technology, actually only hold technology and internet companies, and the largest and most significant one being a 28 or 29% stake in China's most valuable business, which is Tencent. That stake alone is worth around 150 to 160 billion euros in of itself, and some would argue undervalued at current market prices. So given that Prosus's current market cap is only 147 billion euros, and they own a bundle of other high growth internet businesses to be excited about that make up another, say, 50 billion euros or so in estimated asset value, it seems like a bet with a lot of potential upside. Now, it is true that holding companies do always tend to sell at a discount to the underlying value of their assets, mainly because of layer complexities, tax allowances, management behavior, among other things. But going by Prosus's own estimate of net asset value back in October, September, the shares are currently selling at 55% of that estimated NAV, which is very unique. Going by my own estimate, I think it's more like a 40% discount to NAV, 40% plus discount to NAV, but it's still a large gap. And if we dig into the earnings power of Prosus's assets, just to see if the reason why it's selling at a discount to NAV is because they are internet businesses, are they egregiously overvalued? We see that the business is actually extremely cheap, even using traditional valuation metrics. What I mean by that, as an example, is the total operating profit of Prosus's businesses produced 8.2 billion euros, which came to around 7.2 billion euros after accounting for head office expenses and new investments, so reinvestments back into other companies and ventures. That gives Prosus an underlying PE of around 17 to 18 times, all whilst the businesses and assets they own are growing at 30% plus, which gives you a PEG ratio of 0.5 or 0.6, depending on how you range the growth. So although these methods of valuation aren't traditional for holding companies, it does suggest to you that the reason for the discount to NAV is definitely not because the underlying assets are egregiously overvalued. In fact, it's probably more the case that they are close to being egregiously undervalued. And a PEG ratio of anywhere from 0.5 to 0.6 is going past even being GARP, growth at a reasonable price. That does get, at least me, in my opinion, to the point where I think it is very much undervalued. And I personally think Prosus should sell closer to, say, 20 to 25% discount to net asset value, which could, if we're talking in buy-side analyst terms, give them a near-term price target of $90 to $99 per share. Plus factor in that Tencent, which makes up 75% of the NAV, could well be undervalued by 20 to 25% itself. And the underlying intrinsic value of all the assets, including Tencent, should compound at, say, 20% for the next few years. Well, if you combine all of those factors together, that makes a very impressive potential IRR. No doubts, negative China sentiment will be a headwind on the thesis in the near term. I understand that. I think everyone understands that. But looking past that, I think we'll see a lot of progress. Now, of course, most people, including myself, would see betting on Prosus as mainly a bet on Tencent, as it makes up the vast majority of the company's assets, and after all is the reason why Prosus or Naspers ended up getting so much attention. And I already own Tencent directly. It makes up around 5% of my portfolio, depending on price volatility. But what's also impressive about Prosus is its other success from investing in early stage technology companies, mainly from back in its Naspers days, but all of those businesses have now been transferred to Prosus with Tencent, and they have the same management team, with Naspers owning the majority of shares in Prosus. So it's complex, I know. But anyway, it's estimated they've achieved north of a 25% IRR, even excluding Tencent, on their other investments in the past. So you're in the hands of good, maybe even great capital allocators with Prosus. And my decision to buy Tencent directly in the first place was mainly due to it lending itself to much less complexity and risk of my investment thesis being wrong or even being disproven over time. After all, Tencent in itself is a very complex business. So adding another layer of complexity didn't suit me at the time. And I still stand by that decision. I'm very bullish on Tencent, but as I gradually learn more about Prosus and how they work, and I think about whether I want more exposure to Tencent, I find Prosus more and more interesting and think it could provide much less risk to an investment thesis than I originally thought, and comes with obviously more upside optionality given the discount to net asset value and the other high growth assets. So for 2020, I may be considering increasing my Tencent exposure, but potentially through Prosus, like many super investors I follow have done themselves, including the likes of Monish Pabrai, Rob Vanal, Sequoia Fund, and Guy Spear. Now, the next stock is actually a small cap that we haven't covered before on this channel. However, I shared my thoughts and initial analysis with the Patreon members in Discord. So you can check that out if you're interested, but I'm going to briefly talk you through it and talk you through why it's on my watch list for 2022. Very briefly, I'm not going to be able to get to all of it in this video, but you should go ahead and check it out yourself. So the stock in question is Semler Scientific, and it does trade on the NASDAQ, but with a tiny market cap of just $600 million. A quick shout out to Yen Liao, who actually introduced this stock to me through an interview he posted on his YouTube channel. I actually stumbled across him on Twitter and started watching some of his interviews, which are absolutely fantastic. So I'd suggest checking his videos out and following him if you haven't already. Another channel run by a guy called Brad Kellner also did a dive into the details of Semler. So again, I suggest checking that out too if you want more information. I found it very useful myself to get another opinion and listening to what Brad had to say to it. Anyway, a bit of background on Semler Scientific. They provide technology solutions to the healthcare industry that assists in evaluating and treating chronic diseases. For now, the business has just one fully established product called QuantaFlo, and QuantaFlo is a device and software that tests for peripheral arterial disease, otherwise known as PAD. It does so with a high level of accuracy, and within just 5 minutes it can give you a result, which when compared to other methods, mainly being the traditional ABPI test, is around 50 to 100% better, with the ABPI test usually taking around 10 to 20 minutes. It's also a lot more patient friendly, with it just being a small click device that attaches to your finger, rather than the ABPI, which uses 2 blood pressure cuffs that wrap around your arm and your legs for 10 to 20 minutes, causing some discomfort. So they're launching or have launched another product as well, but it is unknown what it is at this point and when we'll hear about its progress. So there's not much that we can take from any of the other products that they have in the pipeline, apart from maybe some potential upside optionality if it is a success like QuantaFlo. And so what's interesting here, at least product-wise, is that they have a product that is much better and more suitable for use versus the current method. So they are somewhat of a disruptor. Now, viable competition seems to not be present yet, at least from what I can see, the keyword being yet. They do have a patent up until 2027 for this product and this technology. So I'm guessing unless a new technology comes out or a new method, then they're not going to have a viable competitor at the moment. But don't hold me to that. That's just from what I've seen in my research. And there are similar methods, but nothing that seems on the scale of QuantaFlo. And the fundamentals as well look fantastic in that you've got true GARP characteristics. The next 12 months price to free cash flow is around 20 times, so 20 times free cash flow, almost a 5% yield. Earnings are growing in excess of 30%, so your PEG ratio is sitting way below 1 there. Your free cash flow yield plus growth rate is north of 34%, 35%, which is usually a good indication of a higher IRR. There is evident pricing power with gross margins increasing from 74% to 90% in just 5 years. Incredible unit economics and returns on invested capital, north of, say, 40-50%. They are disrupting a very large market and only penetrated less than 5% of the current TAM. And with it being a small cap, $600 million market cap, there is plenty of room to run. The revenue is mostly recurring through subscription and license, although they do have one-off payments for products or one-off licensing for products that are around 40% of the revenues or something around that. But it is mostly recurring, paid by, say, health insurers and health consultants. So it's sticky revenue, a sticky revenue model, which usually means the free cash flow is quite safe at the moment, at least. So it all looks rather incredible, almost too good to be true, but there evidently is some risk involved here. Like I said at the beginning, they only have one established product for now, which puts the company at risk of industry innovation and Quantaflow demand sinking. That would really hit revenues. It's also a concern that I found 60% of their revenues are made up of just 2 customers, lending itself to obviously a concentration risk and a major revenue hit should one of those customers or partnerships part ways. In my mind at this stage, though, the upside outweighs the risk, and we're getting a very fair price to reflect that risk. I'm continuing to research Semler at this moment and will be looking out for additional updates, new information, and the new additional products that are hitting the market in 2022. So it's definitely one to look out for, and it's something that's going into my watch list for 2022. I thought I would put it on your radars and suggest that you go digging into it yourself. Let me know, obviously, if you find anything. There is the possibility, I'd say there is the possibility of a 10-bagger or more here, just because of how small the market cap is, how big the market potential is, and of course the business economics and all of the characteristics, etc. And so that's going to be all for this video, guys. I'm hoping you enjoyed the insights and add these 2 businesses to your 2022 watch list. Let me know your thoughts in the comments below. I will leave a link to the Patreon in the description for anyone who's interested in supporting the channel in exchange for benefits. Those benefits being valuation models on these 2 businesses we mention here, plus exclusive analysis and much more. So other than that, please leave a like, subscribe to the channel if you haven't already, and I will see you all in the next one. Bye-bye.